Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into a line of credit and you don't save money, right? So, in this video, saving money, we're going to emphasize that saving money is not allowed here. And one of the reasons why a lot of Americans get into debt is because of this thing called income segregation. Income segregation, okay? So, what does that mean? It means your paycheck comes in and then it gets split all over the place because of your debt. You're paying a credit card here, two auto loans, a student loan, a mortgage, you pay your general expenses, and then whatever's left over, you're saving it. But what we should do is we should attack all of our money, put all of it into debt, and then we use a line of credit to help us do that. That's what velocity banking is. So you see this savings right here? This is going to be zero. We're not going to save any money, but we're going to assume we have the same income and the same expenses, and for this example, I'm only using $6,000 of credit card debt. And the reason I'm doing that is because, believe it or not, the average credit card debt in the US is only about $6,000. I was watching this news story about, like, oh my goodness, it's the end of the world because there's $1 trillion of US credit card debt. And, when you see these news stories, it's like over dramatic, like, oh my goodness. And then you realize, oh, it's just $6,000 per house, per user, or per person, right? And so if you take a look here, I've done scenarios where people had like 100 something thousand dollars of credit card debt, and we got rid of it in like 3 years, no problem. Okay, so not a big deal to me. At least for me, it's not a big deal. But we'll just go with a quote, little bit more realistic scenario for now. And we're also going to have something called cash flow. So it's kind of like savings, but it's kind of not, right? And we try to increase our cash flow immediately. And we're going to do that with the help of a line of credit. So it's a line of credit. All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. So this is my line of credit here. $280,000. So what does this mean is that I could literally go to a bank's website, click a button, and they'll dump $280,000 or up to, um, with a 7.5% interest rate, cash in my checking account, right? Even many ways better than a credit card. Okay. And they only charge me 7.5% interest rate. Isn't that interesting? Okay. So this is what we're gonna do. We're just assume that we have a $20,000 line of credit. And if we ever try to get a line of credit when we have too much debt, they ain't gonna give it to us because the banks don't lend money to people who need it. Interesting, isn't it? But for the purposes of this example, let's make it easy and we'll just assume that we're gonna transfer $6,000 into a line of credit, and then this is gonna be 0, right? So this payment goes away, and so now we've increased our cash flow by $190. Okay, so let's go ahead and do the last step, which is put our entire paycheck into the line of credit and then take our expenses out and then rinse and repeat over and over again. And let me just kind of speed run the calculations. So I'm gonna do this minus so to get the next month's balance is based on the previous month's balance plus the previous month's interest minus 1087.79. Whoopsie. Minus, okay, 1087.79. Yep. All right, that we go. There we go. And then let's calculate the interest. It's based on the average daily balance, multiply it by the interest rate, and then divide by 12. And then, whoa, look at that. Ooh, all right, that's paid off in 6 months. That was easy. 6 months. Like that? 6 months. All right. So 6 months to pay off 6K. Now we got all this other debt. And so now we potentially could have $1,000 of savings into our savings or checking account left over, right? Now, here's the biggest problem that most people have is they're never going to overpay an amortized loan, right? It's not that they can't. It's not like a lender prohibits it, but the lender just assumes that you're not going to do it because it's the loan is a one-way street, right? So even though let's say that we might use a higher interest rate line of credit, 8%, as long as we have the cash flow, or if the interest rate has a huge difference, right? So let's say like a 3% mortgage versus an 8% line of credit. We can use what we call the chunking method, which is just moving parts of the principal from the loan into the line of credit and then just making sure that we dump all our money into the line of credit, right? And the main reason why we do that is so that we don't segregate our income. That's really the main reason. And then if we don't do that, it's an easy way for us to pay off our debts. Okay. So let's just do this and figure out what the current balance of the loans are. And I think I have this right here. Yeah, okay, good. So this is month 6, and this is like the current balance of the loans, right? And we use what we call the cash flow index system to help us pay it off. Now, if you want to know a safe way to pay off this debt, really safe, okay, just take the lowest cash flow index. Usually anything under 50 is fine. But if you see a interest rate difference, for example, 3 and you're paying it off with an 8, use the chunking method. It is the safest way in general to help pay it off and not segregate your income. So what does that mean? Basically, you just take a piece of the loan and move it into a line of credit. And then we're going to start off with this one. Okay. So how much is how much are we going to chunk? Well, we could just do maybe like, an equivalent to a paycheck. It doesn't really matter, just a small amount. So actually, let's just do this. We have this velocity banking calculator right here, and normally we don't use it till the very end. But the thing is, we in this example, we're just assuming we have a very small line of credit, and we had the reason why we start off with big lines of credit in the very beginning is just to make the math more dramatic, right? And usually when you have a huge credit card and move it to a line of credit, the results are very, very dramatic. It's very shocking, right? So let's go ahead and do this. So we'll do this right here. So 20 grand, 20,000. That's the current balance. 1818258.42. And the interest rate, what's the interest rate? It is 6%, 6%, 10 years. And what's the payment amount? Oh, it's 5 years. It's 386.66. So 386.66. So 5 years. And then what's the current income? It's just everything except for the loan, or the expenses is everything except for the loan we're trying to pay off. So I just got to copy this, and then I just do that right here. And this is my cheat sheet. Whoopsie, did I screw up? Yeah, I think I screwed up. All right, so 4025.55. So let's do that. 4025.55. All right, we paid it off in about half a year. Something. Oh, you know what? I was like, this seems off. Like, this is 600% interest. Oh my goodness. I was going to get a heart attack. Like, usually it's like $500. Like, what? That's like the interest of a 30-year mortgage. But all right. All right. I'm getting a heart attack. Like, 600%. Well, at least it works for a 600% loan. All right, 500. All right, so this takes 1 year, so this is going to be 18 months to pay this sucker off. And then this is wait, is it 1 year? Yeah, 1 year. Okay. And then this is going to be 26K paid off, and we just rinse and repeat over and over again, right? So now at 18 months, I just put 18 right here, 18 right here, 18 right here. And all right, so now we just do the same thing, right? So same thing, 25,000, 25,000. What's the current balance? 18,015.42, 18,015.02. And then this is going to be 3.99%. And then here it's going to be 460.3. 60.3, and then we just got to update this expense numbers to include everything except for the loan we're trying to pay off. So this is whoopsie, it's still there. Okay, so 3565.25. So 3565.25. Okay, 0.7 months. So, or yeah, 0.7 years times 12. So we'll say 9 months. So what's 18 plus 9? Oh, I'm sorry, 18 plus 9 is 27 months. And then it's equals 26 plus 25, 51K. All right. So, all right, give me 1 second. Okay, so student loan. I just gotta fill in the deets and the numbers, and that's the cool thing about this loan calculator. Is that how you call it? You just plug and play the details with this with your numbers, and that's it. So 20,000, 610, 20,000, 10, 6%. Take this out, and then cash flow. This is, why did I put 51 here? Okay. 3343.21. So this is now 3343.21. Okay. And then the current balance is, what is the current balance? It is 16481.51, 16481.51. And the payment amount is 843.21, 843.21. And then 0.8 years. Interesting. All right. So we got that. So it's 27 plus 0.8 times 12. And then it's 37 months, which is 71K. And then now it's the same thing with the mortgage. Wait, did I screw up? Hopefully, I don't think I did. Hopefully I did not. Okay. Same thing here, 30 years, blah, 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 blah. Wait, did I screw up? No, I did screw up. My bad. It's 222.04. So 222, a 0.6 years. Okay, so let me try. My bad. I'm going so fast, speed of light. So it's 27 plus 0.6 times 12, which is 35 months. So let's do this. 35 months. All right, 35, 35, and then 0. And then it's so now let's just do this. And I think what's our monthly expenses? It's 2,500. So 2,500. Okay. And then it's a 3% 30-year mortgage. And then 843.21. What's the current 20? It was a 200,000. My bad. My bad. All right, $200,000, and then you just 187,462.87, 187,462.87, and paid off in 5.7 years. Well, blam, we are done. And so now it's 35 divided by 12 plus 5.7, and 8.6 years. We are debt free. We are debt free. All right, so that's it. I've done so many of these. Someone tells me, you're in $100,000 credit card debt. No problem. But the average person would be like $6,000 of credit card debt. My life is over. And that's why anytime you go on YouTube's or the news, right? You type in here, I'm going to go in here, credit card debt, right? It's always like the end of the world. Economy's worst nightmare, struggling with credit card debt. Well, record number only making minimum payments, and that's kind of like what we're doing, which is the exact opposite of the minimum payments, which is dumping all of your money into debt with the help of a line of credit. All right, well, that's it, folks. Velocity Banking video for today. Believe it or not, we're at 3,900 subscribers. Can you believe it? 3,900. Got to find the homepage, but it's okay. All right, so maybe we might do a live stream today if I feel like it, or maybe not. Who knows? But there is one live stream a month at least for YouTube channel members, 99 cents a month. So give me the money. Give me the money, right? All right, have a great day, and I'll see you all in the next video.